If we do have a correction at this point with so many people, especially retail traders in the market right now, that if there is a correction, it could wipe people out because so many new traders since COVID don't understand what they're up against. Basically, the Federal Reserve, okay, the Fed, is buying up on average on a month $80 billion in treasuries and $40 billion in mortgage-backed securities from the government. And that is how they're getting money. They're basically saying, we'll keep lending you money, and as leverage, we're going to keep buying all this debt from you, right? And you're going to have to pay us back at interest, or at low interest because the interest rates are basically zero. So we're going to keep doing this, and we're going to pump money into the government for you to keep spending and keep doing all this stuff, right? And this is what's happening every month, and this is what the Fed has been continuing to do. And then everybody's concern is they are going to taper. In other words, cut back on the amount, right? And if they cut back on the amount, what's going to happen is that, you know, the ability to free flow capital is going to slow down. And it's okay to taper if you're tapering and the economy is rebounding, like you know, you've got employment increasing, you've got, you know, spending and retail and consumers. You want to see them cross. You don't want to see is a flat line and a dip. Okay? So that's why everybody's concerned about what we call tapering right now. It's the Fed slowing down its purchases. Okay? It's literally trying to slow down the purchase to kind of get us to a normalcy, because you can't do this forever or you will have runaway and hyperinflation. The economy's not going to crash. The dollar's not going to crash because, listen, our debt is owned by American citizens for the most part, or American corporations, and nobody out there is going to not lend or not buy up the U.S.'s debt thinking that they're going to default on their loans. So it's not like we're going to crash, but the price of goods will go up as it happens. And it's basically, you know, what we're seeing. And we have the moratorium happening and the freeze and eviction freeze. And the next thing you know, you're going to have 12 million people that might lose their homes. Now, the government's going to have to continue to do something. Otherwise, you're going to have 12 million people in the streets. So, yeah, so there's a lot going on. Negative $400 billion. That means $400 billion in customer brokerage accounts, either through cash that they have on hand or borrowed money, margin, is tied up in equities. If the value of those equities go down, two things happen. Number one, nobody has cash on hand to buy those dips to drag it back up. And if we start seeing tapering or a interest rate rise, then there's not as much free flow cash or cheap money to borrow to buy those equities. And that's why you guys are saying, ask me all the time, like, Stocky, why does tapering matter? Why does tapering matter? Why does interest rates matter, and why the markets react to this? Because there's more risk involved, and people start selling positions. That's why the market starts dipping. People start selling positions because they want to have cash on hand. Because if there is a dip, these people either have to sell their equities at a lower amount, right, in order to recoup some of that cash, or they have to hold. But they have less cash on hand to buy the dips, meaning the chance of a quick rebound lowers. And if tapering happens or interest rates are raised, there's less cheap money to be borrowed to buy those dips. And more importantly, most people's margin is 1-to-1 to 2-to-1. So if you have $10,000 in your own money, but you're at a 2-to-1 margin, that means you're 20,000 more, but this is debt. This is borrowed money. This is borrowed against the equity you have. So let's say there's a market correction and you're down to $5,000, okay? If you lose 50%, that means you've also lost $10,000 in margin. You can't cover this because you can't have 20,000 against 5,000. You can only cover 10,000. So they're going to say, hey, we want $10,000 from you now. Well, you have $5,000 of your own money, and now you owe $10,000 because you have to deposit money to keep that 2-to-1 balance in play. But if you only have $5,000, even if you liquidate your assets, you're still negative 5,000 in the hole. Now, add a zero to that. So basically, everyone is at the casino right now, but they're using the casino's money because they don't have their own. How smart is that? Now, that doesn't mean that we're going to crash, but that's what that chart means. And that's meaning that if we do have a correction at this point with so many fucking people, especially retail traders in the market right now, that if there is a correction, it could wipe people out because so many new traders since COVID don't understand what they're up against. I'm a fan of margin. I'm a fan of margin for investing. Why? Because if I have $50,000, okay, I could put that entire $50,000 in the market and buy VU and let it ride. Or I could throw $20,000 of my cash in the market, borrow at 2 to 1. So now I have $60,000 in VU. I'm letting that bad boy ride up, paying a very nominal amount, but I've still got $30,000 cash on hand to do something else with, or to put somewhere else, or put in a yield account, or put in my emergency fund. And if the market corrects, depending on how much I've gained since then, I've got plenty of cash to cover. So I'm basically using someone else's money for the risk and the reward with my own capital to cover. Because here's the thing. Let's say the market does correct, right? This is why I tell you guys on the way up, when you sell, take a little bit and put it in cash if you're concerned about a market pullback. Because here is the thing. And this is in one of my latest YouTube videos. You're 60K riding up, 20K of your own money. This thing goes on forever. You're making money at a leveraged position more than anybody else, right? But if the market corrects and this drops down, let's say to 10K, right? And you get margin called, but you have this cash on hand, you now have cash to add to your position at a cheaper valuation on the equities. So now you've doubled your position. You're back to your equity amount, but you've got twice as much gap fill. If it drops 10%, 20% to the upside, and you go again. So how do the rich get richer? Well, the rich get richer because here's what happens. I always tell you guys the market, I didn't make this up, this is Buffett, I think, but the market is all about, investing is all about patient people taking money from impatient people, or rich people taking money away from poor people. It's how it works. But a lot of times, poor people put themselves in the situation. Well, they're in a situation of desperation is why they end up putting themselves in a risky situation. But here's the thing. You're some kid who has $10,000 and you're unemployed. You throw your money in the market. You have 2 to 1 leverage on margin. You ride it up. Market starts crashing. You get hit in a margin call. What happens in a margin call? You're forced to sell equities in order to cover that. Well, guess what you're doing? You're selling the bottom in order to cover your margin call. But when you sell the bottom, who the fuck do you think you're selling to? The asshole that has the cash on the side. So now he gets a discount on his shares to ride up because you were playing with a lot of volatility and risk. You got margin calls. You're forced to go liquid at a discount. I mean, you have to. It's not even panic selling. You're forced to sell at a discount. You've lost money. Someone else is buying at a discount, and they're going to ride that shit back up. And by the time you go back to work and make enough money to get your money back, you're buying those equities at the same valuation or higher than where you sold them. And who do you think you're buying them from? The asshole who bought them from you down here.